Hello class, this is Dr. Carl Letamendi and this is a video lecture of chapter 11 of the personal finance text, and the chapter is titled Personal Risk Management, Retirement and Estate Planning. Retirement and estate planning. Insurance is about protecting what you have. Retirement and estate planning is about protecting what you may have in the future. Now, this chapter in particular doesn't go way too deep into the topic of retirement and estate planning, and I'm not an expert in estate planning. This chapter is meant to just give you a general overview of what this means. Retirement planning and estate planning are plans to create and then protect an accumulation of wealth. And of course, we're going to be talking about wills and such a little later in this video. Learning objectives. Identify the factors required to estimate savings for retirement. Estimate retirement expenses, length of retirement, and the amount saved at retirement. Calculate relationships between the annual savings required and the time to retirement. And it's very important to note that that as it relates to this video lecture in particular, we're talking about the U.S. system of retirement. Other countries have their own state-funded pension system. The most comparable thing that we have to that would be Social Security, but Social Security is not now that it's been several decades. It's not meant to be a retirement. We can't afford to retire off of it, unless of course you're gonna go abroad and such. Retirement planning, projecting needs. I want to be able to afford a nice life after I stop getting a paycheck. But what is a nice life and how will you pay for it? And that is the, the fundamental question. To estimate required savings, you need to estimate the expenses in retirement, the duration of your retirement, which is kind of silly because you'd have to know when you're going to die, and the return on savings in retirement. As difficult as these estimations seems, because it is a long time until retirement and a lot can happen in the meantime, you can start by using what you know about the present. So you can project some needs. There's some expenses in retirement. You have current expenses, lifestyle changes, and also inflation to consider. You have the duration of retirement, which is, like I said, life expectancy. So, I mean, good thing we don't know when we're all gonna die, right? But life expectancy also plays a role because you're not expected to have a fully funded retirement for another 100 years after you retire. It's not going to last you that long. Then you have return on investment in retirement. The higher your return, the less is needed. The lower the return, the more you need to contribute now. Projecting savings until retirement. Budget surplus until retirement. You have current expenses, lifestyle changes, and inflation. Time until retirement. You have age in your career stage to mention. As we discussed in previous video lectures, the career stage that you're in determines how much of your expenses you've already paid off, ideally. Return on investment until retirement. The higher the return, the less savings are required. The lower the return, the more savings are required. So it's not just retirement shouldn't be considered just one lump sum thing that just comes into your bank account after you've already reached a certain age. Here are some needs, key takeaways. To estimate required savings, you need to estimate expenses in retirement based on lifestyle and adjust it for inflation, the duration of the retirement based on age at retirement and longevity, and the return on savings in retirement. You must save more for retirement if expenses are higher, the duration of retirement is longer, and the return on savings in retirement is less. Your annual savings for retirement also depends on the time until retirement. The longer time that you have to save, the less you need to save each year. And there is, of course, one exception to this rule for people who were already of the pre-years to retirement, who lived through the collapse of the real estate market in 2008, the financial crisis. A lot of these investments that were connected with that were pegged to mortgage-backed securities and that were tied to the real estate market also took a significant hit, and there's people who lost everything because they had all their money in one basket, so to speak, and that one basket was in an enterprise that fully invested in real estate because they perceived it to be the most secure thing, right? How could it collapse? It's you build a house, people live in it, people need a place to live, right? But there it got a little bit more complex once you injected derivatives into the equation. So, but that's just one example, and it's a risk that you also take. You have to be very careful where your money is, and you got to know exactly where all your eggs are. Ways to save, learning objectives. Compare and contrast employer, government, and individual retirement plans. Explain the differences between a defined benefit plan and a defined contribution pension plan. Summarize the structure and purpose of Social Security and state the difference between traditional IRA and a Roth IRA. Identify retirement plans for the self-employed. So I'm going to take a break. Since we said Social Security, and I want to give you a fun fact. If you want to take a moment, this is actually your first clue here for extra credit for participation. If you're watching this video, thank you very much. You can just let me know what it is that I'm talking about, or just email me the name of the guy that we're talking about now. This man's name is Upton Sinclair, and he was actually the person that was turned to. If you go to the Social Security website, he was a person who was turned to help draft the blueprint for the Social Security, and he was actually a socialist from back in the 20s and 30s, and this was after the Great Depression, and he helped to draft a plan, an epic plan, which eventually became the Social Security Administration and so the idea of Social Security. So it's interesting to see how like now, circa 2015, where we're living now, everyone is completely opposed to socialists, but the Social Security Administration is a socialist plan. It's a socially constructed, socially beneficial plan that was developed by a very vocal socialist back at the time who actually almost won the California election for governor. So that's your first clue, and just wanted to give you that fun fact. Now back to the presentation. Okay. There are a couple ways to save when we're talking about retirement planning. You have individual, employer, and government uh, plans, so to speak. And in an individual plan, which is at the individual level, you can either have an IRA, or if you're self-employed, that also subdivides into other areas. You have in the IRA, you have two types. You have the traditional IRA, which is the individual retirement account, or the Roth IRA, and they both behave a little differently in terms of like how you can roll in money into another, and you can get more details if you have like Wells Fargo or Bank of America. They have pretty good descriptions of both types of IRAs, and that help to define them in lay terms, so you can check those out. For the self-employed, you have SEP plans, a simple and a KIAL plan. This is a breakdown of the retirement plans. Important questions to take into consideration when comparing between traditional and Roth IRAs. The age limit to create the there's an age limit for the IRA, 70 and a half years old, none for the Roth. Age limit to contribute, yes for the traditional, no for the Roth. Tax deductible contributions allowed, yes for the traditional, no for the Roth. Tax deductible contributions limited, and yes, it's limited by income and not applicable to the Roth IRA. Non-deductible contributions allowed, yes, yes for both. Non-deductible contributions limited, yes for both. Withdrawals taxed, yes of the deductible contributions and not for the Roth IRA. Minimum required distribution, you have a minimum required distribution for the traditional but not for the Roth. The age of mandatory distribution is 70 and a half, and you don't have one for the Roth IRA. And the minimum age for distribution is 59 and a half for the traditional Roth, and for the traditional IRA, and then the same for the Roth. Then you have employer plans. They can be either a defined contribution or defined benefit. And then we've heard of these before, right? You have the 401k plans, which are that if your company uses like certain retirement companies like Valak or TIA Craft, right? These are 401k retirement plans. Your money is invested in the stock market by that brokerage firm, so to speak, and then you contribute money to the 401k. It's pulled from your paycheck. Usually, your employer will contribute a set amount, like 2% of your check or 1% of your check, depending on the employer. And they allow you to contribute also up to a certain percentage. And if they do what's called dollar per dollar matching, then that helps you a lot because then you can actually you can actually get more earnings if assuming that the market is flat in a pessimistic situation. If your employer contributes dollar per dollar, it's like doubling your investment. That's just the way that I'm gonna say it. So even if you put your money in a conservative portfolio with whoever is managing the 401k, you're still gonna get money from your employer. So if you're planning on staying at your employer for like 30 years or 40 years and then getting the gold watch and staying with them until you're ready to venture off, this is a good strategy to use because the employer is going to be contributing as much as you are, if not just a little bit more. So after you're fully vested in the program, when you withdraw the money at the eligible age, it's like you doubled your money. So that's kind of like a little hiccup in the system, but it's a way to ensure that like if you put I don't know, over your lifetime you put 250K in the account, you're gonna walk away with half a million without even worrying about market volatility. The 403B plans are similar, but they're traditionally for nonprofit organizations. And then you have the 457 plans, which we'll talk about a little bit later. And then you have the defined benefit plans for the employer. In the government, you have Social Security, which I just talked about, which was implemented in 1935 after the Great Depression of the 20s. And then you have the Federal Employees Retirement System, right? These are the pensions that the government employees get. So back in when I was working for a couple of government entities, if I recall correctly, I think that for people who are almost of retirement age right now, what they get is 80% of their income for life. And for people who are younger, like me and all of you, the pension amount dropped to 50%. So you get 50% of your salary for life. I'm not extremely knowledgeable in this area. I know that there's a certain age that you have to hit, and there's also a certain number of years that you have to be working for the government in order to get that. So here is President Roosevelt signing the Social Security Act of 1935, which was created by the almost governor socialist of California. Retirement plans, risks. There's always risks. With the employer, you have default risk, inflation risk, and investment risk, which basically means like what happened with everybody in 2008 and their retirement accounts. They didn't really have a whole lot of default risk or inflation risk. Well, a kind of inflation risk, but they had significant investment risk. So even though their employers contributed to this account for them, if that money management firm or that wealth management firm and put all the money into real estate, a lot of people did lose everything. With the government, you have default risk, but they generally say that there's no default risk with the government because if they owe you money, they'll just print out more money and give it to you. Even though it does have a significant impact on the value of the dollar, that's something that's usually tabled for later, not considered right off the bat. And then you also have political risk. There could always be changes to the pension system. Like I told you in previous lives, that I heard that older generations get 80%, and then newer generations are only going to get 50%. So you may be that generation that's caught in the middle between the transition. So that's one of the political risks that you undergo. And as an individual, you also have inflation risk and investment risk. And there's also that risk that I might want to add. another risk, and I don't really know what to call it, but it's the risk of not getting the 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 earnings that you want to get. And the reason why I'm saying that is because with the employer account, with the employee plan, at least you get some money contributed by your employer also, right? So it's like having a parent that matches you dollar per dollar in your retirement account. You don't get that at the individual level if you're like self-employed. Key takeaways: retirement plans may be sponsored by employers, government, or individuals. Defined benefit plans differ from defined contribution plans in that the benefit is a specified amount for which the employer is liable. In a defined contribution plan, the benefit is not specified and the employee is responsible for the accumulation in the plan. Social Security is an entitlement financed by payroll taxes and designed to supplement employer retirement plans or individual retirement plans. This is the key word here: supplement. Okay, so it's not a social security retirement plan, right? It was never retirement plan. So it's always a little upsetting to me whenever I hear people complain that social security is not enough. That's correct because it was never meant to be enough to fund your retirement. True, there are some people who live in other countries and are, like I know in Cuenca, Ecuador, for example, it's a city in Ecuador, and a lot of people who are can you can live in on social security there because the cost of living is gonna be like $200 a month, and you get a big house, and you can eat, and you got all your utilities paid for. Taxes are relatively very low, so that's one example. I mean, if you're anticipating leaving the country, then perhaps, but I'm pretty sure there are some legal ramifications there. Traditional and Roth IRAs differ by the taxable nature of the contributions and withdrawals, and by the age limits of contributions and withdrawals. Retirement plans for self-employed are designed for those who are both employee and employer. Estate planning, learning objectives. And before I move on to this one, I wanted to, oh, where was I? Okay, I was here. Next clue, free extra credit. When we're talking about a pension, right, or retirement, I found this article. Thought it might be really cool. It's on U.S. News Money. It's the jobs with the best retirement benefits. These industries contribute the most money to worker 401ks and pensions. Remember how I told you before um, that sometimes employers contribute money and that's where you're really going to get more bang for your buck? All right, so these are the industries, right? Utility companies, which give you $4.22 per hour in retirement benefits, the most of any industry. So here we're talking FPL, for example, right? Aircraft manufacturing, colleges and universities. Guess I'm in the right business, right? Insurance carriers, transportation and warehousing, and lastly, construction. So if you like to check out that money, you can just Google U.S. News and World Report jobs with the best retirement benefits. And this was is not extremely recent. It's a 2010 article, but I'd say that it's pretty accurate in terms of you know. You can also go to the Bureau of Labor Statistics, another one of my favorite websites. For extra credit, just send me a little message with what this article is about. Well, you don't have to read it, but just tell me what the title of the article is. Okay, so now let's go back to estate planning. Learning objectives. Compare and contrast employer, government, and individual retirement plans. Explain the differences between a defined benefit plan and a defined contribution pension plan. Summarize the structure and purpose of Social Security and state the difference between traditional IRA and Roth IRA. Identify retirement plans for the self-employed. Estate planning is a way to manage your assets after your death. And death has some considerations to it: emotional, legal, financial, and taxable. And this all hits your family after your passing. So now we have wills. Since you won't be here, you will need a written document outlining your instructions regarding your estate. Your will is your legal request for the distribution of your estate. Assets that remain after your debts have been satisfied. Okay, so that's what an estate is. Assets that remain after your debts have been satisfied. If you die intestate or without a will, the laws of your state of legal residence will dictate the distribution of your estate. So this is an example of Will's wills of 1616, right? It's a little unclear, I know. So here we have the difference between a will and probate. A will is witnessed and signed, and a probate is to pay debts and distribute remaining assets. Wills can be subdivided. You have a living will and then power of attorney, which gives financial decision power and legal decision power to someone. And then healthcare proxy is for medical decisions specifically. So in a living trust can be revocable or irrevocable. When it comes to taxes, estate taxes diminish the value of your estate that'll be distributed to your beneficiaries. For that reason, one of the purposes of estate planning is to try to minimize those taxes, which is why there are financial experts who specialize in estate planning specifically so that they can help you to reduce those taxes. Otherwise, it's going to hit your family. The tax law defines the gross estate as the value of all property in which you had an ownership interest at the time of death. Life insurance proceeds payable of your estate, or if you own the policy, to your heirs. The value of certain annuities payable to your estate or your heirs, and the value of certain property you transferred within 3 years before your death. Allowable deductions include debts that you owed at the time of death, including mortgage debt, your funeral expenses, the value of property passing directly to your surviving spouse, which is the marital deduction, charitable gifts, and the state estate tax. Minimizing taxes owed is the goal of estate planning, but not the only goal. Your primary objective is to see that your dependents are provided for by the distribution of your assets, and that your assets are distributed as you wish you were still there to distribute them yourself. So some key takeaways. A will describes your wishes for the distribution of your assets after your death. Probate courts distribute assets in the absence of a will and administer wills and estates with assets valued above a certain variable dollar amount. There are many kinds of wills, including the simple will, traditional marital share will, and the stated dollar amount will. It's a lot of stuff, right? It's a whole business that's built around your death and how your assets are going to be redistributed. Um, just a little side note, this isn't really the orthodox way of doing it, but particularly in my family, and I don't know if this has happened in your family, we kind of like have our own internal type of will system. So if death is anticipated due to illness, that's when like transfer of assets is done before the death is anticipated. None of my family in particular, the ones that live in South America, don't participate in this kind of business. So that's usually how they do it. If there's property, then they'll sell unquote unquote the property to their children and divide the ownership among the children like that, which may not be the best thing to do tax wise, I'm sure, but that's just how they do it. Key takeaways: living wills with power of attorney and healthcare proxy provide medical directives, empower someone to manage your estate while you're still alive, and authorize someone to make decisions about your health and end of life care. Trusts are used to provide the benefits of assets for beneficiaries without their assuming responsibility for asset management. There are testamentary and living trusts, revocable and irrevocable trusts. Setting up and administering trusts involves some considerable expense. Creating trusts and giving gifts are ways to reduce the taxable value of an estate. Estate planning should try to minimize the federal and state tax obligation of estate disposition. And this concludes the video lecture for chapter 11. Your next clue and final clue is this website. If you can just send me an email with this third clue also, with what this website is, then you can also get the extra credit. And I believe this is actually the very last chapter of this class. And if so, thank you for watching these videos. And as always, if you have any questions, comments, or concerns, please feel free to email me at any time. Thanks and have a great day.